Hi, my name is Jim and I was retired. Remember those Roth conversions from a few videos ago or the I-bond redemptions that I made with taxable interest? Well, they generated taxable income for 2023, and that will require a higher fourth quarter estimated tax payment. Now, that got me thinking, should I have been setting a higher withholding from my pension payments instead? For now, I'm withholding judgment on quarterly estimated taxes. In your working life, the IRS wanted its money up front through withholding. As you were paid, it was paid. But once you're retired, the rules change. In truth, the IRS doesn't care once you're a retiree whether you pay taxes through withholding or make accurate quarterly estimated tax payments as long as you pay what you owe. I've been reading several articles this week weighing the pros and cons of withholding and estimated quarterly payments. And I'll take you through them and provide links to those articles in the notes below. And later in the video, I'll show you how I made an estimated tax payment online directly without mailing in a little statement you get from your tax software or an accountant. The federal income tax is a pay-as-you-go tax. You must pay the tax as you earn it and receive it during the year. And there are two ways to do that. Withholding. If you're an employee, your employer probably withholds income tax from your pay. In addition, tax may be withheld from certain other income, like pensions and bonuses and commissions and gambling winnings, and the amount withheld is paid to the IRS in your name. Or estimated taxes. If you don't pay your taxes through withholding, or you don't pay enough taxes this way, you might have to pay estimated tax. Now, if you are in business for yourself, you generally have to pay taxes this way. You also have to pay estimated taxes if you receive a lot of your income from dividends, interest, capital gains, rents, and royalties. Estimated tax is used to pay not only income tax, but other taxes like the self-employment tax and the alternative minimum. Now, lower in that same IRS document, 505, it notes that you have an option to choose not to have income tax withheld from a pension or an annuity, except if it's delivered outside the United States. It's your choice. Just know that if you estimate wrong in your quarterly tax payments, you may be penalized. And that penalty will include higher interest rates on the delay in the payment of that tax. Now I'm going to take you through a few of the articles that I found, including this one from Charles Schwab about managing taxes in retirement. And it notes that calculating the obligations can be tricky once you are in control of your income in retirement. It notes that during your working years, an employer typically withholds income tax on your behalf, helping you to avoid underpayment penalties on tax day. But when you get to retirement, you generally have multiple income sources that may or may not be appropriate to have taxes withheld. That's leaving you to have to pay estimated taxes throughout the year. And if you don't make the right estimated taxes, the tax bill can be bigger than you expected. So this article takes you through several questions to ask as you figure out whether I withhold or pay estimated quarterly taxes. What is the source of the retirement income? If it's ordinary income, like a job in retirement, then you're going to get your employer to withhold taxes from that. But if it's interest payments or ordinary dividends, short-term capital gains from your broker, it's not necessarily convenient to have withholding from those kind of payments. You're going to have to make estimated quarterly taxes for that. And now down here, it notes that annuity payments may or may not be taxable, so you have to figure out whether it was pre-tax or post-tax dollars that purchased the annuity. And then pension payouts, if it's paid by the employer, it's going to be taxable to you, and you should have taxes withheld or account for that in your quarterly estimation. Long-term capital gains could be taxed at zero, so it doesn't make any sense to have withholding from those gains. Figure them out first and then make them part of your tax liability paid quarterly and settled up at the end of the year. Now, how much are you withholding? Generally, you'll go through a W-4 for a paycheck or a W-4P for a pension payment or a W-4R for a single payment out of a retirement plan. There are rules from the IRS on how to figure all these out. You also have the option of having taxes voluntarily deducted from Social Security. Keep in mind that up to 85% of your Social Security benefits could be taxed depending upon your income level. But whether you want the tax withheld from the payment is still up to you in Social Security. Now, what do you owe? Figuring out the tax can be complicated. I happen to use TurboTax or the Excel download that I talked to you about before. There are several calculators online that you could use, as well as your own TurboTax software. Check out and see what it has in it for estimating your estimated tax payments or withholding. What's your payment plan? You could adjust your withholding, which is, again, an option. Go into your withholding and withhold more than you were in the past and minimize the quarterly payments that you need to make. Or you could make quarterly estimated payments in addition to whatever withholding you have. I have found that doing a mixture of both is probably the best. This blog from Experian.com noted that you can calculate your estimated quarterly tax payments and use a regular installment method. And that is one adjustment divided by 4 and send in those 4 payments. However, if your income status changes throughout the year, you may want to use a second method called annualized income installment method. And that is better if you have a seasonal business or income in retirement comes a lot in the fourth quarter, then you want to make sure you're going through the process of annualizing your income installment method to accommodate for that. You're going to make sure that the first 3 payments actually met your tax liabilities and you're just adjusting the fourth quarter. Otherwise, you have to account for any tax payments that might still be due from the first, second, and third installments with your annualized approach. I found this article from Zinner and Company, a CPA in Ohio. It had a nice, helpful list of pros and cons on paying quarterly estimated tax payments or withholding. And the pros for quarterly approach to it is you have cash on hand throughout the year. It's easier to adjust for unforeseen financial changes. If you've already set up your withholding from your income stream of a pension, for instance, then you're pretty much locked into it. But if you've done quarterly payments, you can change those quarterly payments each quarter. The cons are there's a chance of increased penalties and interest for those underpayments if you get it wrong. And you have to remember to do that. Now, a lot of people are scared off by that. Some people mail all 4 quarter payments in at once to make sure they don't miss them. Don't do that. There are ways of scheduling it through direct pay ahead of time and get it done. I put them on my calendar to remind myself to schedule an automatic payment. I don't have to mail a check with a little coupon. It's going to be better that way. Now, withholding, the pros are there's less chance of penalties and interest on underpayments. It's low maintenance. You set it at the beginning of the year, and it's viewed, here's an important thing, it's viewed as by the government as paid throughout the year, regardless of when you actually have the tax withheld. So withholding for a few months late in the year might make a difference. You could try that approach to change the withholding if your pension payer allows you to change that mid-year, then you could do that. You can adjust. Or you can make a withholding from a non-periodic payment, like a withdrawal from an IRA. Change that to satisfy your tax bill, for instance, in one payment. I saw another article that suggested that you could use an RMD if you're later in retirement. Settle all of your taxes due with a high withholding from an RMD. That's another way of handling the efficiency of a withholding approach as opposed to estimated quarterly taxes. The cons are there's less cash on hand and it's more difficult to adjust to unforeseen substantial financial changes. Here's the other thing that scares me, and one of the reasons why I'm interested in doing a little bit more withholding and a little less quarterly estimated taxes is what happens if you've got to make that estimated tax and it's not readily available. You don't want to be borrowing money to pay taxes. So setting up a comfortable withholding on your periodic retirement benefits gives you more flexibility to use the quarterly estimated tax payments plus the withholding from the non-periodic IRA withdrawals to settle your tax bill. That might give you more flexibility in your tax paying approach. And right below the pros and cons of quarterly estimated tax payments and withholdings, it notes an important safe harbor that allows you to avoid any penalties if you make sure that either method that you're using or the combination of those two methods pays either 90% of your current tax year liability right here or 100% of your prior year's tax liability. Now, it does note that if you're an individual with a adjusted gross income greater than $150,000, you'll need to cover 110% of the prior year's tax liability rather than 100%. Now, let's take a look at how to make a payment. Most of us are familiar with something like this for an estimated tax voucher that you have to mail in to an office. But there are options to pay online, and you should research those and find out which works best for you. And you can pay your quarterly taxes with one of these methods. A debit card, there'll be a fee for that, or make a payment through the electronic federal tax payment system. You'll receive documented proof that you have made the payment, or pay with a check and a money order that you mail through with a coupon, a 1040 ES. So here is the irs.gov payments website, and make a payment, pay now from your bank account, pay with direct pay. And you go through and say, I'm going to make a payment, and it's going to ask you first a little bit about why you're making this payment to the IRS. So you're going to select a reason. You're going to make an estimated tax payment. Their estimated tax payment. And it's going to say, apply that payment to that form of 1040 ES. And then it's going to verify that you're going to pay it for the current year. And if so, you're going to continue. And then it's going to ask you for a way of identifying yourself based on past tax records. Select the last year's tax return, for instance, and the filing status that you had last year, and your name, and confirm your social security numbers, etc. And then it will validate you. But there's a better way of going back to that page and using the sign in to pay. And that is signing into your own irs.gov account. And you should have one in retirement to make sure that you can have access to your tax records as well as your tax payments. And you sign in with an existing account here, and it's going to use ID Me to sign yourself into the account. It'll send you a text code back to your phone as a two-factor authentication. You're going to enter that in, and then you're going to go through into your account. And once you're there, make a payment. You won't have to go through that extra validation step. Now here, it notes that there's a limited account services available during maintenance. Make sure you're making a payment in a normal processing period of time. And then you make a payment. You can also go in here and see your past payment activities if you want to see what your first 3 quarterly payments were. You can validate it with that screen and see, and then you make your payment option for your 4th quarter. I'm paying the 4th quarter 2023, but here in 2024, here are the due dates that you're going to have. You're going to have one that's due for the last quarter of 2023 that's due January 16. Then your next payment will be due for the first quarter. It's April 15. That's exactly when taxes due. So you're going to get prepared for paying your taxes due for 2023 plus your first quarter estimated tax for 2024. Then you'll have another one on June 17 for the second quarter, and then on September 16 for June through August. And then everything after August, from September 1st through the end of the year, is due next January. That's right. Everything from September 1st through December 31st, 2024 won't be due until January of 2025. So, what do? Do you have withholding and increase it to minimize the quarterly estimated tax payments? Or do you stick to a schedule of estimating quarterly tax payments and having regular payments? Or do you annualize? Write down in notes below what your approach is to managing your taxes in retirement. I'd be curious to learn that. Please like and subscribe to this channel if you like entertaining ideas from a DIY retiree. I'm not selling a course. I am simply sharing my perspectives to help you prepare for your own DIY retirement. And as always, I will conclude with my standard warning. I am not a CPA. I am not a financial planner. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.